Hey guys, welcome back to another episode of the Genesis Blog podcast. Today we have Yash presenting for us the FRAX protocol. So with that, over to you.
Hey guys, so today we're going to talk about FRAX. FRAX is a all-in-one DeFi platform which offers a range of services. So it was founded in late 2020 by this guy called Sam Kazemian, and basically it started as a stablecoin platform. So the way it works is FRAX is it's a partially collateralized stablecoin which also has a algorithmic mechanism to stabilize the peg. So we'll go to the details of how exactly that works. But what you need to know is it's kind of a fusion of MakerDAO's DAI and something like a fiat-backed stablecoin like USDT or USDC. So it tries to, get the benefits of both of those two completely different ways of creating stablecoins and create a decentralized stablecoin that is as capital efficient as possible. So that is one aspect of FRAX. Then they expanded their product lines. So they offer 3 services as well. The first one is called FRAX Swap, which is essentially an automated market maker similar to Uniswap, but employing slightly different mechanisms. They also have a lending market called FRAX Lend, which basically functions very similarly to Polygon or AAVE. And they have the latest product line, which is called FRAX Ether, which is a liquid staking solution for Ethereum, similar to Lido staked ETH. With that, FRAX has been implemented on Ethereum as well as 17 other chains, including Polygon, Phantom, Binance Smart Chain, Avalanche, Arbitrum, Solana, Moonbeam, and a bunch of others. There's currently around $1.1 billion of FRAX circulating. So it's a USD peg stablecoin. So, I mean, the total stablecoin market cap circulating coins is around close to 100 billion, maybe slightly less. And just 1% of that is FRAX, which is 1.1 billion. So it's barely anything if you look at the total stablecoin supply, but it still is the second largest decentralized stablecoin after MakerDAO's DAI. So there's lots of potential and decent amount of hype around FRAX because it's employing a pretty unique design as compared to any other stablecoin out there, and the team also seems to be building very vigorously in this bear market and constantly pushing out new products and services to just increase the sources of revenue for the protocol as a whole. So before we go into the details of these different product lines, do you all have anything to add, comments, etc.?
Nothing specific. I think you're going to touch upon it anyway, but I think it would be very interesting to get into the detail of how this algorithmic stablecoin plus, collateralized stablecoin model works in practice, because, we've seen the frailties, I guess, of algorithmic stablecoins brought to light this year with the implosion of UST, and it's just very interesting to explore whether that fragility can be mitigated a little bit by having an element of collateralization included alongside that algorithmic angle. And another angle that I would like to explore is the use of USDC and USDT. Did you say that they use USDC and USDT to maintain the peg to a certain extent?
Yeah, so it's only USDC. So it's partially collateralized by USDC, and the rest of it is algorithmically stabilized using FXS, which is the protocol's governance and utility token, similar to Luna and UST, but definitely not the same thing.
Yeah, but yeah, I think so that's an interesting angle to explore. I mean, USDC is definitely one of the most trusted products in the entirety of crypto, but we know now by this point,
yeah,
what
I
the
hate
word
that
trusted
word now. I just
exactly,
don't.
right?
Yeah,
So we know now what the word trusted actually means, and it's actually at this point in time, especially, it's a bit of a bad word. So and we've said this before on the podcast as well, and I think we hold true to it, and we've been held held true to it since the start. You're as centralized as the least centralized, you're as decentralized as the least decentralized aspect of your stack. Now, if FRAX is collateralized by USDC, which itself is a centralized stablecoin, then and it purports to be a decentralized stablecoin in the exact same vein as Maker, as DAI, how decentralized is FRAX actually? And I think that's a debate that might be worth having for a little bit, even though we've had similar debates in the past. But yeah, just those couple of things from me.
Sure.
Also-
So I mean, before we go for it.
Just one point I'd like to add, I mean, stepping back before we get into the weeds, is that I personally find, I mean, the discussion we're going to have, not just of FRAX, but of stablecoins in general, one that is particularly interesting to me, and probably more interesting than other episodes that we've done, because arguably stablecoins are probably the product that's closest to product market fit in the crypto ecosystem, if not already hit product market fit. Of course, majority is due to centralized issues, but nonetheless, stablecoins has emerged as the lifeblood of crypto, really. And discussing on the what the path to decentralization is for the lifeblood of crypto is something that is not only interesting but also extremely important for the path forward given the last 2 weeks.
Absolutely. Agreed with that. So with that, let's just dive into how the stablecoin is exactly designed, right? So stablecoins today, as we kind of discussed, but let me just elucidate it better. Stablecoins fall into 3 buckets today in terms of categories. So the first one and the biggest category by far is fiat-backed stablecoins issued by centralized entities. So the biggest 3 stablecoins today are USDT, USDC, and BUSD, issued by Tether, Circle, and Binance respectively. They're issued by centralized entities, so we as users have to trust, or in the case of Circle, they're audited by the US government to make sure that they have enough reserves and that they're backing their whatever issue. They're backing their stablecoins issued with a 1:1 fiat counterpart, right? So in that sense, Circle, like you said, Sid, is the most trusted because it's a US-based company, so it's audited, and the SEC obviously regulates it. So compared to Tether and BUSD, which are offshore, if I'm not wrong, they're relatively more unsafe. But so far, Tether and BUSD have both maintained their pegs, but that doesn't mean they will in the future, right? Then the second type of stablecoin is crypto-backed, over-collateralized stablecoins. The main one obviously is MakerDAO's DAI. It has around 5% of the market share, which equates to like 5 billion circulating supply. And the third type, and the obviously least successful type of stablecoin, is the algorithmic stablecoin. So as we all obviously know, Luna and UST was like the flag bearer of algorithmic stablecoins, and people were convinced at one point that that would be the future of stablecoins. Obviously, that was proven wrong, because it's very easy to cause a bank run, a debt spiral, and depeg an algorithmic stablecoin. So with that, FRAX has introduced a new design choice over here, where it's backed partially by USDC and partially by its governance token called FXS. So what that means is, let's say if you want to mint $1 worth of FRAX, and there's a collateralization ratio essentially, which dictates how much of the fiat-backed stablecoin do you need to put as collateral, and how much the remaining would come out as FXS. So to give you a better example, let's say you want to mint $1 of FRAX, and the collateralization ratio is currently at 88%, for example. That means you put in $0.88 of USDC and the remaining 0.12 of FXS into the contract. You mint $1 of FRAX, your 0.88 of USDC remains as collateral in the system, and the remaining $0.12 worth of FXS is burned, right? So this burning and minting mechanism is very similar to what Luna employed, and this collateral, adding collateral to mint a stablecoin is very similar to MakerDAO's DAI. So in a way, it's under collateralized, and the burning and minting process helps maintain that peg, right? But you may ask what gives FXS's value, and even though it isn't completely algorithmic and mostly collateralized, what's to stop a bank run, right? So a bank run usually happens when FXS, FRAX is burnt and FXS is minted in large amounts to essentially defend that peg, right? Because you'll burn $1 FRAX to redeem your collateral, and that's how burnt FRAX then decreases the supply and brings that peg back to $1. But if people are okay, redeeming FRAX, that if it has an innate value accrual mechanism, then the peg can be maintained even in times of volatility, because the FXS token has some underlying way of accruing value and has its own innate value other than just the fact that it can be used for minting and burning, right? So what is FXS's value accrual? We'll get into that later, but for now it just suffices to know that it does have a value accrual mechanism and it does have intrinsic fundamental value. So that's basically how it works. If you want to ask some further questions so that we can discuss it a little better.
Yeah. So would you say that like the minimum amount of collateral that FRAX has is that collateral ratio averaged out across all of the FRAX that has ever been issued? Like, for example, I mean, I don't want to get into like the granularity of the exact amount of collateral that's there in FRAX's ecosystem at the moment, but from a high level, is it fair to say that they've got a base that they can always withdraw and convert into USDC, and essentially allow people to have like a base layer of capital that they can draw upon in times of
Right.
distress?
So I guess we do have to get into the FXS value accrual, because that's kind of key over here. So basically, FXS is the governance and utility token of the entire ecosystem. What that means is every time you burn and mint, there's a fee that needs to be paid. So that fee essentially goes to the DAO treasury. And then also the other services that we touched upon earlier, such as FRAXSwap, FRAXLend, and FRAX ETH, they all charge fees on these respective platforms to borrow and lend, or to trade. They charge fees. So whenever the protocol has excess fees in the treasury, what they usually do is they use those fees and they buy back and burn the FXS token to always put buying pressure and also reducing the supply of the FXS token. So all the revenues accrued to the protocol are only used to buy and burn the FXS token, just so therefore tying it all together and making that token valuable. And then since that token's valuable, it allows the token to defend the peg in times of volatility, because people don't mind redeeming their FRAX for FXS to maintain that peg, because they know that the token eventually will accrue more and more value, or hopefully rather.
And what if you deplete that reserve? What if you deplete the reserve of fees to maintain that peg? And what if the peg breaks?
I mean, it's a lot harder to break the peg because it's mostly collateralized, right? So it would take, so for example, Luna was 100% algorithmic, and the Luna token itself didn't have any innate value accrual mechanism, right? So it was the only value the Luna token had was the fact that it was getting burnt, which was putting upward price pressure. And, this started a positive flywheel effect. And this was mainly kind of fueled by Anchor giving absurd yields, right? So people automatically wanted to mint more and more UST and burn more and more Luna. But we saw how that, that flywheel can go the other way and lead to a downward spiral. And because this is mostly collateralized, so in general, the collateralization ratio has been 85% or above, and only partially algorithmically stabilized. It's a lot harder, and it would require a lot more capital to cause a bank run on the protocol, because you don't need an entire dollar of FXS to stabilize the peg. You need 10 cents on the dollar to stabilize the peg, if you think about it.
So is it fair to say that 85% is the floor collateralization
That's what
ratio, or is that just a historic?
Yeah, no, so it's they don't have like a hard floor. It's completely determined by market forces. And the hope is that as FXS has more and more product lines accruing more and more revenue, that can become a larger part of the, so basically the collateralization ratio can go down and it can be more and more algorithmically stabilized. Now, I don't know if that's a safe thing to do, and maybe they should have a minimum collateralization ratio to ensure that even in times of intense market volatility, the peg can be defended. But they also want to be the most capital efficient stablecoin, which, I mean, fair to say, I think so far the peg has been defended very successfully. Even when USD collapsed, there was a minor depegging, but it was very immediately reversed and it came back to $1. So
Just to summarize, actually, I'll ask a question before I summarize. So let's say that like the collateralization ratio is 85%, right? And let's say that someone is really trying hard to break that peg. So they're basically just attacking the FXS portion of this. And let's say that all of those reserves that have been accumulated from the fees are depleted in trying to save this, trying to save this peg, and then the peg breaks. Is essentially like the amount that creditors will get be $0.85 for every dollar of FRAX they own, because they will have enough capital. Let's say that they issue like 1 million FRAX and they have 850,000 USDC, and then they've got like the rest in FXS, and then they spend everything that they've got in FXS to defend that peg. They can't do it, and then the peg breaks, but then that floor level that it finds is $0.85 for every dollar. Am I looking at this correctly?
Yeah, absolutely. I mean, so if you compare it to Luna and think about it, Luna was 100% algorithmic, right? So theoretically, if the price of Luna goes to zero, there's nothing that's really holding up the USD peg, right? Even USD will automatically go to zero, which is what we saw. Here, the minimum, you still have 85% of it collateralized by a real fiat-backed stablecoin. So yeah, that is theoretically the floor price that in the event of a mass liquidation event, creditors would still be paid back, 85 cents on the dollar.
Okay, I mean, that's fair. Go on, Sid, sorry.
No, I just had a question on, so the collateralization ratio, now how is that determined? Is it algorithmically?
Yeah, so it depends on two things. So one is FRAX's price on the open market, and the second thing is the amount of liquidity of FXS available across different DeFi platforms, essentially. So I'm not sure the exact formula, but those are essentially the two things it depends on.
Got it. So the formula though is hard coded into the protocol, and it's not
So they've designed the protocol with the need for, like, basically with the very minimum need for any kind of DAO governance intervention. Like the things that the DAO can vote on and proposals that can be made are very limited in scope, and they don't really change the core working of the protocol. To change that, you would have to hard fork the protocol and start from scratch. They've ensured that the core base mechanism will always remain the same at a smart contract level.
Got it.
And just last question on this, because it is like one of the core pieces of this protocol. As an attack vector, what would again, like, you don't have to know this, but like, what would like one of the worst attack vectors on this be? Like, would it be if you borrowed FRAX at like leveraged amounts and basically just shorted FRAX FXS, and then therefore tried to break the peg in that way? And then there was a concerted attack, basically like a concerted short attack, trying to drain like liquidity, or basically just basically get like the amount of FXS that can be defended below that critical line, and then like the last line of defense is that USDC backing collateralization.
Yeah, I mean, that would be like the worst case scenario for FRAX, wouldn't it? Basically, the way the protocol ends essentially is if FXS goes to 0. So you need to do something to make FXS go to 0. So there's two ways to do that. Either you somehow manage to leverage up and massively short FXS or something like that, or you need to keep minting. You need to keep burning more and more FRAX to mint a shit
More
ton of
FXS.
FXS. So yeah,
you
I mean, the
basically
only
need to
way to
increase
do it is
supply,
to accumulate. You just need to accumulate as much FRAX as possible to fuck the protocol
then
up.
burn
But I
it,
don't
but
see
then you'll
how
lose all your money.
Yeah. I mean, you have to be like an anarchist who wants to bring down the protocol to do that.
I'm
I
sure there are
guess
like other ways to do
if
it.
you have
like,
if you have a,
yeah.
I mean, if you have a short position on FXS and then you buy a shit ton of FRAX, that makes sense, right? Then if your profit on your short is more than the amount of FRAX you've burned to mint FXS,
Yeah.
then
I
you're
guess
in
the
profit.
economics,
But I guess
that is an economic vector, right? It depends on market conditions significantly though, and you would hope that the DAO, I don't know how much this, like you said, like I don't think you said that they have too much decision making power, but like
yeah, they don't.
hopefully in those situations, you would hope for the DAO to like change the risk parameters or something like that to account for this, or basically, I don't know, like stop that attack vector from happening by blocking that address or something like that. I don't know, right? Like this is just throwing ideas out there, but yeah, just because obviously like we're wary about the different ways in these things that these things can collapse, not without very good reason. So just wanted to understand what the different attack vectors could be and what the worst case outcome could be. I still like, is there in your opinion no way in which like one FRAX is basically worth 0 because of that USDC cushion? That's basically it, right? Like how can it, let's put it another way, how can it go to 0? What can make FRAX go to 0?
The USDC
I mean, it would take
USDC has to break, right? Kind of.
I mean, if USDC breaks, then we have bigger problems than FRAX collapsing, don't we?
100%. I hate that we keep getting to this, where if USDC breaks, we have bigger problems than X collapsing. If USDT breaks, we have other problems than Y collapsing.
It's centralization risk. It's the classic case in point for centralization risk.
Yeah. So the way I guess FRAX moves forward is they need to diversify the collateral that's allowed. So if you have diverse amounts of collateral, and if it's diversified enough, even if one of the potential collaterals collapses, the rest can kind of shore it up, and hopefully, the price of FXS will be affected. It might fall a lot, but still the peg can be defended, hopefully. So I guess that's probably what they're thinking in terms of future roadmap. And maybe if you allow more volatile cryptos like Bitcoin or wrap Bitcoin and ETH to become collateral, you could do so at a higher collateralization ratio.
Yeah, but then you get into less capital efficiency like DAI, right?
Yeah, so I mean that's the inherent trade-off you have to make, right? You can't be both. You can't be safe and also be the most capital efficient. I don't think that's possible.
Yeah.
Anyway, so that's the FRAX stablecoin. So before we move on to FRAXLend and FRAX Swap, I just want to touch upon one thing. So FRAX came out with this thing called FRAX Algorithmic Market Operations. Essentially, what it is a set of mechanisms where FRAX can essentially use these different operations to earn revenue from different sources across different protocols. So for example, they have 4 AMOs right now, algorithmic market operations. The one is the investor AMO, where idle USDC that's sitting as collateral goes and earns yield in AAVE, YEARN, etc. The second one is the Curve AMO, where they deploy FRAX to Curve, essentially, and they deploy and get rewards to their pools by buying a massive amount of Convex, essentially. So that's the cost, and the benefit is the rewards they get from their Curve pools. The third one is a liquidity AMO, where you can provide liquidity for FRAX pairs on Uniswap and other AMMs and earn a fee on it. And the last one is the lending AMO, where you can mint FRAX into over-collateralized lending markets for a fee. So essentially, FRAX wanted to use these different AMOs to create alternative revenue sources, and whatever revenue is accrued from these different AMOs would be used to buy and burn the FXS token to, kind of keep that value accrual going to the token to ensure that it has value, right? So basically, the Curve AMO that I spoke about is the largest AMO by far in terms of the revenue it gets into the protocol. So the benefits of this Curve AMO are pretty obvious for a stablecoin if you think about it. One is it maximizes the liquidity between FRAX and 3-pool tokens. So essentially, the 3-pool is the biggest pool on Curve right now with USDC, USDT, and DAI. So essentially, what they're doing is creating a pool with FRAX and 3-pool LP tokens to ensure that there's enough liquidity for FRAX on Curve, right? And this deep liquidity helps maintain the peg also, because it's a lot easier to trade FRAX and mint and burn it if you want to, and keep that peg at $1. Then, of course, they accumulate fees and LP rewards from Curve. And they also own a lot of convex, and this large amount of convex helps them boost their rewards that much more. So majority of their the AMO distribution is pretty much the Curve AMO. The other three are kind of way less in terms of overall revenue brought into the protocol. And there is a concentration risk because Convex and Curve is a majority of the rewards that accrue to the DAO treasury. But at the same time, this risk is mitigated by the fact that they pretty much, they sell their rewards periodically to essentially buy FRAX FXS then and burn it, right? But the problem with these AMOs is they had to deploy them on other protocols, which essentially meant that FRAX was not able to have complete authority over how its stablecoin was being used. And to make their stablecoin as perfect as possible, they kind of wanted to be insulated from the risks of other protocols like interest rates and smart contract risk, etc., which is why they came up with FRAX Swap and FRAX Lend. So before we get into those, if you have any questions.
Yeah, I have one question. So the capital that's deployed through these AMOs is essentially all treasury capital, or is there some other source?
No, so you as a user can you can also deploy your own capital to earn a share of the fees, but like a small share of that fees will always go to the DAO treasury.
Okay, so no, I'm not.
You can, but yeah. No, so they do use the treasury funds for these different services to accrue more and more fees. So in terms of like, let me give you an example. So what they do with treasury funds is they buy or they use the FXS token in the treasury to bribe convex holders and accumulate more and more convex. Then they use that convex that they've acquired to get more and more fees and rewards on Curve, right? And then those fees directly accrue back to the FXS token holders in the form of the treasury, then use like treasury taking those rewards and changing them into FXS, and then the FXS getting burnt.
Got it. So is it fair to say then the capital that's being deployed through these AMOs is a combination of existing treasury capital and also the deposits of USDC that are made by users?
Yeah, exactly, right.
So I can I can go in and do it. Like I can go and find an AMO.
Yeah, so they have an all-in-one dashboard where you can do all of this, right? So you can mint and burn, you can redeem rewards, FRAX Swap, FRAX Lend, FRAX ETH. They're all part of this one platform where you can go and do everything. It's called app.frax.finance. It's it's a very clean UI, and you know exactly what each tab is.
Got it.
So yeah, so now with those AMOs, the problem was that they were very dependent on other protocols to do this. So FRAX Swap essentially is was created by FRAX with this in mind. Essentially, what it is it's a constant product automated market maker with an inbuilt time weighted average market maker system. So what that basically means is the time weighted part essentially means you can make large trades over a period of time and ensure that there's minimal price impact on your trade. So instead of the Uniswap constant product on V2 where if you have to exchange a large amount, you incur high slippage. Over here, it's a different mechanism where the trade is split up into infinitely small trades essentially and executed over a longer period of time so that your trade basically has minimal price slippage. Now, so anyone can use FraxSwap because it's an open source protocol, public utility type thing. But the main use currently of FraxSwap is essentially to use for the buyback and recollateralize functions used to essentially ensure that $1 peg on Frax. So they've earlier it was like a separate tab, I guess, on the platform with a rudimentary kind of UI. Now they've cleaned that up and integrated that entire thing into FraxSwap. So you can mint and burn and essentially defend the peg on FraxSwap, but you can also exchange other assets on FraxSwap. So in a way, it's a exchange that has a core function, but anyone else can also use to create liquidity pools.
Now, what exactly is the differentiator for FraxSwap? Like, would I just use it cause I have Frax?
So it's the first time-weighted automated market maker, which means that large trades, for example, the alternative uses of FraxSwap could be accumulating a treasury asset over time by selling governance tokens or buying back governance tokens slowly over time with DAO revenues and reserves. Normally, these things are very tough for DAO treasuries and DAOs to do in general because they have to because it's embedded in a smart contract, there's no one actually manually inputting trades, right? So you need a efficient way of conducting a trade over time with minimal price slippage for a DAO. So it's useful for other protocols to use it, not really an average retail user. It's targeted as
fair. That's good.
For other protocols.
Honestly, that's good. That's better.
Yeah, and then even if you want to do a DAO to DAO swap, you can swap one governance token for another in a kind of crypto merger. That would be easier to do with a time-weighted AMM as compared to a regular AMM.
I see the benefits from a B2B perspective essentially, but won't it again be determined by the amount of liquidity that exists in the market in the what do you call in the AMM, and if the use case is narrow, then wouldn't that mean there's always going to be less liquidity?
Yeah, I mean, but it's still that core function is still for minting and burning Frax and FXS, right? So, and to do that also, it charges a user fee, and that fee is again used to buy back and burn the FXS token. So even if it doesn't succeed as a independent AMM, it still has a core use essentially. I mean, all FraxSwap has done is kind of integrated the UI a little more to make it more all-encompassing instead of just having that base burn and mint mechanism over there.
Okay.
So FraxSwap is still, it's relatively new and the traction is kind of limited right now. It only has 50 million in TVL. So that's really not much. But still, it's fairly recent, and I could see it having a use case in the future, especially once the bull market kickstarts a little bit more, and treasuries have accumulated a few more assets, and we'll see a lot more activity happening in DeFi when it comes to DAOs and protocols, and that's where FraxSwap could shine. So with that, the second service is FraxLen. Also a product line that they try to introduce. It functions pretty much identically to something like AAVE, where you as a borrower, you deposit collateral and you can borrow whatever asset you want, usually FRAX ecosystem tokens, and a lender can essentially deposit liquidity and earn yield in the form of F tokens, which are similar to C tokens or A tokens. And then again, all the fees accrue to FXS holders indirectly through buyback and burn. And then they've also added certain additional features such as custom term sheets for over-the-counter debt structuring. And these structured deals can have specific maturity dates, restricted borrowers and lenders, under-collateralized loans, and limited liquidations. So again, this is not targeted to retail users, right? This is more for protocols and DAOs, essentially. And also it allows unique OTC trades that something like Compound or AAVE couldn't really do, or maybe AAVE could do it through AAVE Arc, but still a unique, relatively unique use case. But essentially, it functions exactly like AAVE for all intents and purposes. But all it does is it increases the coverage of FRAX overall, increases the fees accrued to the protocol, and why not?
I mean, like, yeah, all of these guys are converging in the same way, aren't they? Like Maker, AAVE, FRAX, same
this
kind of
is
product.
going to be my next point.
Yeah, like good. We're same wavelength. I'll let you carry on with it.
Yeah, so essentially now that we've spoken about stablecoins, we've spoken about AMMs, and we've spoken about lending markets, right? And those three can be considered the holy trinity of DeFi, right? If you think about the core use cases of DeFi, it's those three things, right? Like Uniswap is the biggest AMM, AAVE is the biggest lending market, and obviously the biggest decentralized stablecoin is DAI, right? So what if you had a service that encompassed all three aspects of this DeFi ecosystem, right? So FRAX is obviously there now, even though they don't have the traction on FraxLend and FraxSwap as some of their competitors. But at the same time, the competitors are also kind of preparing for this convergence of the different, DeFi functions. So Curve and AAVE are both releasing stablecoins sometime soon, maybe end of this year, beginning of next year. Uniswap probably, or not Uniswap, but SushiSwap probably also would try to create a stable coin. The difference is though that FRAX started as a stable coin and ventured into the others, while the others are starting as lending markets or AMMs and venturing into this.
Do you think Uniswap's gonna create a stablecoin?
No, not Uniswap. I meant SushiSwap, because they're a little more experimental, and Uniswap, you can tell from the community that they want to remain just a pure hyperstructure where they have one simple function.
Yeah. Biggest DEX, stay the biggest DEX. Don't complicate it.
It depends how you look at it. Whether you think that DeFi all these protocols need to integrate all these services, or should they just make the existing services better, right? It's in my opinion, I think there's no harm creating more products as long as they're safe at a smart contract level, right? You're just increasing the reach and revenue sources and if tokenomics are designed correctly, it can accrue more value to the token holders as compared to just having one service.
I'm not following one thing. So the whole point of these applications, let's take FraxLend and FRAX ETH over, say, the exchange, because that still has a fundamental use case. The whole point of these applications is to increase the value of FXS, correct?
Yeah.
But then beyond these absolute niche use cases of OTC debt structuring and whatnot, why would anyone use it? Like, so is the bet that these B2B services is going to be that they predicted to be that large to bestow FXS with utility large enough to maintain the peg or maintain the algorithmic part of the peg? Is that the bet here?
The point of FRAX is for FRAX to be the biggest decentralized stablecoin, right? So the way FRAX is minted, the only way more can come into circulation is if FXS is burnt, right? And you put in more and more collateral into the platform. And for people to think FRAX is valuable, they need to be ensured that the peg will remain stable. So how does the peg remain stable? It remains stable using the USDC collateral and the FXS. So FXS needs to have value for that peg to be maintained. So how do you maintain and create more value to FXS? You do that by accruing fees and using those fees to buy back and burn FXS. Now, how do you accrue fees? You accrue fees usually when providing liquidity or lending. Like those are the main two ways you create fees for a platform, right? And the newest one, which we talk about, is also FRAX ETH, where they want to get ETH staking yield and use that staking yield to again buy back and burn FXS. So it's all about increasing value of FXS so that more and more FRAX can be minted and the amount of FRAX in circulation goes up.
I understand that, and I guess what I'm trying to get at is, if you look at it from the team's perspective, right? I'm trying to figure out what their thesis is. And as a retail user, like we've already discussed, we're unlikely to use these protocols because we already have more established counterparts for each of them, right? You have Lido, you have AAVE, and you have Uniswap, right? I mean, I would at least more likely use them than any of these protocols. So then the target is naturally the businesses or the other protocols and DAOs. So what I'm trying to ask is the team's thesis that the demand from these DAOs is going to be large enough to give AXS the necessary revenue to get some intrinsic value?
I think the thesis is that if they went identical to Uniswap or AAVE, for example, they would get zero market share from them, obviously, right? Why would you use something identical? So they had to differentiate themselves somehow, and I think the way they chose to do that is to make their FRAX swap and FRAX line more conducive to DAOs to use as compared to a retail user, because anyways a retail user would have to really research and know about FRAX, right? But DAOs would do their research and they would know the best destinations to trade or lend and borrow. And FRAX, I guess, is trying to position themselves as that. And in terms of FRAX Ether, I think it doesn't really cost much, especially since the price of Ethereum dropped so much to run a validator node. So there's minimal risk in doing so, and it's also a diversified revenue stream in a way. Obviously, it's a really small revenue stream because staking is more and more competitive, and validators are competing against each other. So I don't think they expect to gain like massive market share on Lido or something like that. But let's say that even a retail user would maybe know that Lido is 70% of all staking power right now. They want to diversify out of that. Maybe they choose FRAX, right?
Yeah, I don't know. That last bit probably I'm not convinced on that, but I think the answer is clear.
It's minimal risk to them, right? Like what does it cost to run a validator node, especially when the price of Ethereum is crashed so hard?
Yeah, but then that's like also really like a very narrow viewpoint to look at this through, right? Oh, the price of Ethereum is low now, so like people might be incentivized now. But I mean, that also can be looked at in the other way, going like, oh, the market is absolutely screwed right now. What is the point of running a validator node at this point? And like, why would I do it on FRAX? I mean, you can also make the argument the other way around. I get Sid's point, in the sense that there are better established alternatives. In terms of stablecoins itself, I think that FRAX is an interesting model, but and I do think that the capital efficiency aspect of it is interesting enough, in terms of the collateralization and everything. But the collateralization ratio right now is already pretty high. I just looked it up and it was about like 93%. Would you rather have a collateralization ratio of 93% or 100%? I mean, it's literally like I don't know, right? Like it's pennies on the dollar. And the capital efficiency might increase a little bit, but then and FRAX is there across different chains, which means that it can be usable. But I feel like the product is targeted towards a niche of crypto users who are crying out for a product that has a decentralized stablecoin at the heart of it and can provide all of these three functions together. which, to be fair, I mean, not a lot of people are actively looking for that or definitely not from a retail perspective, from a DAO perspective, maybe, but then that already reduces your target addressable market significantly, especially when you consider that DAOs also have other options to choose from as well, the same options that retail does, right? And those other options are also maybe better suited to DAOs than FRAX maybe. I'm not saying FRAX is like a useless product or anything like that, right? I think it's a very interesting experiment, and I've read stuff that Sam Kazemian has said. I've read about their philosophy and everything. I think that they're pretty interesting. But whether they're going to have the escape velocity to beat the incumbents, I'm not too sure. Maybe they don't want to do it. I don't really know. But yeah, that's my 2 cents on FRAX.
I think it's a bit incorrect to say that, make the comparison right now of, 93% collateralization ratio versus 100% ratio. Because the whole idea is to make it, progressively more capital efficient, because that's the goal. I mean, they're not claiming that this is the end state of the product. But I think, concluding this main question for now is they are betting on they're trying to capitalize on and hoping that the market opportunity for B2B DeFi primitives is large enough to make their stablecoin as capital efficient as possible, without succumbing to let's say the UST Terra risk of going fully algorithmic, right? I think, would that be an appropriate way to encapsulate what they're trying to do here?
Yeah, I think so. I guess what they need to work on, or what they need to tell investors, is how they plan on growing the protocol in the future. What are their future product lines? How are they bringing in more revenue? Because as the value of FXs goes up, they can mint more and more FRAX, which is ultimately the end goal, right? And investors in FRAX essentially invest in the FXs token, right? So there needed to be one, like a unifying way to bring together all of this value into one single token. And if it was 100% collateralized, then how does the platform, or how do investors and the founders make money?
Yeah.
I get it.
It honestly seems like UST with a backstop, from the makers.
A centralized stablecoin.
Yeah, I mean, and that we haven't spoken about that, to be fair, because I mean that's a huge risk vector, right? And you alluded to it earlier, said that the fact that if USD collapses, or if whichever centralized whichever stablecoin issuer they use to collateralize it, if that falls, then this whole it will be called a game of cards at the
Yeah,
end of
but
the day.
it is. But like the thing is that at the end of the day, you can consider it as a form of credit rating in crypto, but I think USDC is pretty high in terms of like
Fair.
credit rating.
Yeah.
Right. So if it collapses, it will be like a major shock major shock is underselling it. Like I don't know what would happen if USDC collapsed, to be honest. It's game over, really, like to a large extent. Then you're gonna have to build up from the ashes.
See, USDC can't collapse like the way Luna and USD did. Right? It can be regulated heavily, and that's the main risk.
No, they can stop. Yeah, they can just stop withdrawals. I mean, that would be effectively USDC collapsing.
That would only happen through regulators, right? USDC or Circle, the company, why would they want to freeze the product that they've created?
No one wants to do it. I mean,
the risk is regulation. So maybe FRAX's path forward is not decentralizing, diversifying the collateral sources.
Yeah, but the risk is also like the FTX risk, which is, I mean, again, they do provide like attestations and proof of reserves and everything. So I don't want to put USDC remotely in the same bucket as this. But the risk is also the FTX risk, where you're just a massive fraud. But then again, like you can't ever, I mean, it's impossible to do business when you think everyone's a fraud. So, you've kind of got that going against the FTX.
Yeah.
Are there any stable coins which have, a tokenized gold as
PAX G.
collateral?
PAX G, Paxos Gold.
Yeah, PAX G.
And
But
how's that doing?
FAXG is, I mean, FAXG is fine, but like FAXG also is like a bit of a weird one. It tokenizes one fine troy ounce of gold that is stored in like some vault in London or something, and it I think like it tokenizes it per serial bar. But like each gold bar has a serial number or something like that, and you have the right to that asset. But I mean, like tokenized gold. Uh,
Like
if you
what I'm
want
trying to get at
gold,
is
like
what
buy
if
a gold
USD?
ETF.
No, what I'm trying to get at is as collateral for something like FRAX, to use, beyond and to diversify away from USDC, maybe use USDC and tokenized gold.
Yeah,
That
but then
would
all
give
of these
you,
are like at the end of the day, like sure, like you can diversify your sources and everything. At the end of the day, like it's still like a bit of a risk. Um,
oh, sorry. There's
I
always
mean,
going
like
to be a risk.
no one's saying no, right? Like you're right. I mean, there's definitely avenues that can be explored about how Frax could do it, but like Frax is also using USDC to maintain that floor. It is using it to maintain that floor. That floor can shift if it's using tax gold, because that floor can actually get lower.
Right, but
For
it's better than Bitcoin. It's much less volatile than
yeah, but no
Bitcoin.
one's
And
saying but use Bitcoin. Like if you're trying to pair a token to Bitcoin, then what are you trying to do? I mean, like
no, I mean that's what that's what Do Kwon did. I mean the LFG had a
yeah,
substantial.
yeah. I mean, yeah. It wasn't like pegging it to Bitcoin. I think he was just like, oh, we
No,
have
it
a
wasn't.
reserve and
Right,
huh?
which is similar, right? Which is similar.
I mean, yeah. Like in
Maybe
that case,
except Bitcoin and Ethereum as collateral for FRAX, as simple as that, right? With higher collateralization ratios, won't be as capital efficient, but would be extremely rugged if they want to go
But
down that path.
then it becomes a die, essentially.
Yeah, but still with this burning and minting process too, because if you think about Maker, the token, it's pretty useless. It's a protocol
Yeah.
backstop, and if it anyways reaches that level, the value of Maker itself will spiral to zero. So, the protocol will be insolvent. They're completely relying on people wanting to mint more and more DAI in an over collateralized way. It's essentially borrowing, right?
it
Frax
is. It
is
is.
different. It's minting. So,
I mean, yeah. And Maker also has
you're
a lot
putting
of
in
other
$1
problems.
worth of assets and getting $1 of assets out.
I mean, Maker
It's a
also
lot.
has a lot of other
That's the whole
problems.
point.
Like, I think that this one is actually like, I mean, if you actually look at Maker and like really look at it, what is it except for like a cabal of people controlled by, like, I don't want to say cabal. Cabal is a bad word. What is it but a group of people controlled by Rune Christensen's delegated Maker tokens? It's nothing but that.
Yeah,
Yeah.
of course. I mean, even his endgame plan, he is like open to DAI becoming a free float currency, right?
Yeah, and he
He's
wants to
okay
like
with that
create.
peg not being defended and whatever. So that's a whole different issue, I guess.
Yeah, exactly. But like yeah, the whole maker thing is a different topic. But I see, I at the end of the day, I don't think Frax is like a bad experiment or anything. As long as it doesn't like go crazy and abandon its collateralization ratio, abandon like its start scaling like insane, then you know that there's a problem. Because if you're trying to grow too fast, then like you are going to, I mean, especially in a system like this, slow and steady wins the race. A little bit, and for something that is as systemic as a stable coin, uh, yeah, for something that's as systemic as a stable coin, you need to be a little slow to go about this.
Yep, agreed. So with that, we've spoken a lot about the stablecoin landscape. We've spoken about how Frax works, and now it's on to the meat of the discussion, which is tokenomics, obviously our favorite aspect of any protocol. So we kind of discussed FXS already, and how it accrues value from different product lines, fees, etc. And those fees are used to buy back and burn the FXS token. But FXS has also implemented a V tokenomics model very similar to Curve. So, they've incentivized holders in another way to ensure that they must hold their token in the form of VFXS and, vote as accrued FXS to ensure that they get a share of the fees and boosted rewards, very similar to what Curve does, right? So So one FXS token can be locked for a maximum of 4 years and generates 4 VFXS tokens. The amount of VFXS decreases linearly as the unlocking date approaches, and users can relock their VFXS whenever to reset/increase their VFXS balance. And it's also VFXS is used to vote on governance proposals, etc. And staking your FXS for VFXS is the obvious thing to do, because that prevents dilution of voting power over time, right? Very similar to Curve. So they've also introduced that game theory aspect, which has made Curve so successful as a protocol, into FRAX itself. Now, I don't know if they're just trying to do, just combine all the best practices of DeFi into one protocol, and whether it makes sense to have VFXS, but clearly it's another way to incentivize holders to lock their tokens in and take off that much of the circulating supply off the market, right?
So is the only thing VFXS is used for governance?
Governance and deciding where rewards go. So essentially, I think there's
Same Curve
25.
stuff, right?
Yeah, it's exactly the same.
What
Exactly
what
the
do the rewards get you? Like, what are the rewards and what do they get you?
So the token distribution has changed from 25,000 FXS per day to 16,438 FXS per day. And I think this reward keeps on decreasing year on year. I can't find the exact amount by which it decreases, but it's around 50% a year. So there's less and less rewards over time, which,
And what do they get you? Like, what do you do with these FXS?
FXS accrues value, right? And you can use FXS to mint
That way.
FRAX. Yeah.
Okay. I mean, at least like there's a clear
Yeah.
use case here.
Yeah,
I don't know, Sid, you seem like you're not convinced by the use case.
I mean, it's not about being convinced or not. I mean, like you said, I think you really put it well when you said it's a worthy experiment. It seems like, I don't know. I mean, see, like there are multiple scenarios. Like, what if FXS is used to essentially grow the circulating supply of FRAX, but if they over optimize for FXS value accrual, why would I even why would I want to mint FRAX? Why would I not want to just hold FXS? So that's
let's say you want to use FRAX to buy something else.
Yeah, I mean, fair, but I mean, at some point.
But you can still get your FXS, that way you can still like burn your FRAX.
Yeah, you can always get it back.
That FXS is always there, right?
No, but do I get the amount that I burned, or do I get the value of it, like at the time?
No, you get yeah. No. So you won't get an equal amount of FXS. You will get $1 back, which can be any amount of FXS depending on what the current market price is.
Depending on the collateralization ratio, basically. So let's say that the collateralization ratio when you minted FXS, when you minted FRAX from FXS was like 85%. So let's say you had, let's say you mint $100 worth of FRAX, right? So you have to supply 85 USDC and 15 FXS, right? And then let's say that you want to burn those $100 back and get your component tokens back. You get, and then let's say the collateralization ratios change to like 88%. You get 88 USDC back, but you get only 12 FRAX. 12 FXS back.
$12 worth.
$12 worth. Yeah. $12 worth. Yeah. So first you minted, you essentially locked away $15 worth of FXS, and you're getting back $12 worth of FXS. That's basically what happens. So the what you're exposing yourself to is the change in collateralization ratio. So in riskier conditions, it's like a two-way street. You have to look at it in two ways, right?
It's kind of similar to impermanent loss, isn't it? If I'm understanding this correctly.
Well, like I would say that it's a difficult.
Yeah, I guess actually you can look at FRAX itself as an LP token, right? And the LP is the ratio is provided in FXS and USDC, and that ratio is dynamic, right? And then when you're minting FRAX, you're essentially minting an LP token that gives you gives you the common right to get back your collateral in USDC as well as your FXS. Now, if the price of FXS changes and the collateralization ratio changes, those are two ways where you can you'll still get $1 worth back, but in a different form.
Yeah.
So in a way, I guess it is impermanent loss, but not exactly. But yeah, I guess that's a good analogy to make.
And the thing is that, like, think about it in like these kinds of market conditions, right? So let's say you have FXS, right? You have $15 worth of FXS in the same example. You're like, and now you're looking at the market and going like, oh God, this market is so bad. I want to lock up my FXS. I want to, like, hold it in a stable coin, and I have FXS. So, I can be a little bit more capital efficient and just deposit my FXS, be rid of like the fluctuation in value of that FXS, and essentially mint a FRAX token, which I expect to be, relatively stable in value, right? And basically the bet that you're making is that you're willing to take the hit that the collateralization ratio increases because the market conditions are riskier. You're willing to take the risk to your FXS by saying that, oh, I would rather have it in a stable store of value rather than being exposed to the volatility of that FXS.
Yeah.
So it's kind of an option. It's not really an option, but like it's just a play. It's just like a thing to do in the market when you want to de-risk.
Yeah, I see this. It seems to me like they're just the whole bet here is B2B adoption, and that, I don't know. I mean, it's retail is not. I highly doubt retail is going to adopt this. I don't see
I mean, unless you create like I have not seen any clear incentives for retail to adopt it. Let's put it this way. Like, retail needs to have incentives to adopt, right? Like, I don't know what exactly it would be here.
No, beyond. I mean, that's probably the most important point. But one additional layer is also just given Luna's collapse and the whole space. I think retail is going to get smarter, and if they don't understand something, they're not gonna, at least in the near future. If you say 2-3 years down the line,
if you think about it, what retail doesn't need to adopt FRAX. Retail needs to believe that the FXS token value will go up. You need more and more people.
Yeah, but that'll happen. What is that? That sounds a bit like a Ponzi, dude. That sounds like that sounds like that.
No, it has a clear value accrual, right? So if it can increase the fees to the token, and if investors spot that early enough, or even if they don't actually, because there's a constant buy and burn, the FXS token should theoretically go up in price, right? So that is the way you mint more and more FRAX into the system.
Yeah, I guess so. I mean,
the product.
I mean, it's sounding similar to Luna and USD, but we know it's not that.
It at least, I think, has a bit more back. It not even a bit more. It has more backing behind it for sure. Like, I mean, the thing is that FXS itself seems more robust. Now, whether, I mean, me personally, I don't know, right? Like, but my risk perspective is different. Like, I'm not a DAO. So yeah. Different. Yeah.
Anyways, so I mean, that's the token demand side. Then there's also the token supply. So there was initially 100 million FXS as the total supply, of which 65% was allocated to the community. And by allocated to the community, it basically was for their liquidity programs and farming and the FXS rewards, similar to Curve. So that's 60% of the total tokens were for that. 5% was for the protocol treasury. And the remaining 35% was essentially for investors and the team. And of that, 35%, all of it has already been invested. So there's no token unlocks coming in the future that anyone really needs to worry about. The only supply increase is coming from, I mean, obviously, if you burn FRAX to mint FXS, or with the farming rewards from VFXS, right? Right. So that's essentially the supply. Pretty solid, if you ask me, because they've allocated a reasonable amount to investors, team advisors. 35% is pretty much in line with the industry standard, and a majority of it to the community. And all of the investors' tokens have already been invested and unlocked. So there's no more selling pressure, massive selling pressure going to come in the future to the protocol. So that's great. Then we can move on to governance. So essentially, FRAX's governance module is forked from Compound, and lots of protocols have done it because Compound has a great governance, or not great, it has a pretty robust governance
Replicable.
system. Replicable, that was the word I was looking for, replicable governance system. I don't know, you want to get into the
It's
details
just
of
Governor Bravo. It's
governance?
not too hard. It's not
Yeah,
too hard. Like Governor Bravo is
yeah,
the name. They use a one token, one vote model basically. They have like
yeah.
a very standard way of submitting proposals. Like then you indicate community preference on snapshot. After that, you first post to the forum, indicate community preference on snapshot, take it forward to an on-chain proposal and like the governance dashboard. The on-chain proposals comes with an execution payload essentially. So that means that when the on-chain decision has been made in favor of, the proposal can be executed automatically. So it's got this, I guess, if it's the same system, then it's got the same benefits of ease of use and understanding across the ecosystem that Compound's Governor Bravo does. But then the issues are obviously the same in terms of inflexibility of governance, whale problems, one token, one vote problems, those kinds of things. Unless I'm incorrect about this, Yash.
No, yeah, it's pretty much exactly that. And it's also pretty minimized because the proposals that can be made themselves are quite limited. So you don't need as much active governance as some other DeFi protocol.
Yeah,
So yeah,
which
that's
is a
the
problem. What does
governance.
that mean? What do you mean it's limited, by the way? Sorry.
I mean, there's the proposals don't really affect the core working of the protocol. It's more things like token pairs to be allowed on FraxSwap, or the rates that how to dynamically change the interest rates on FraxLend, things like that.
Isn't
They're
that
not
a bit of an
at
issue?
this. I mean, why though? If they've already proven that the product or the protocol is pretty robust, especially in terms of maintaining the peg, which is its core function, right? So why fuck with that core function?
Yeah, I mean, fair. The whole decentralized. Yeah, I mean, like to be fair, I'm not like advocating in favor of. I don't want to advocate in favor of like more stringent and granular on-chain governance anyway. Because yeah, like on-chain governance is both a curse and a boon. So you know, um, yeah, I guess like it
Yeah.
remains to be seen how centralized this gets.
Yep. So then we can look at, just the protocol revenue and the DAO treasury real quick. So I think the protocol does an annualized run rate of around $100 million in accrued profit, which is quite great. And they also have a DAO treasury balance of $120 million. The problem is it's very concentrated in convex, essentially. It's a convex FRAX LP token, essentially, where most of the treasury is concentrated. But Convex and Curve have proven their robustness and their longevity. And even though there is concentration risk, I think there's worse assets to be concentrated in. And Convex obviously has its usage because they can incentivize a lot of liquidity on Curve using Convex and create new pairs, which they did, for example, with FRAX ETH. They created a ETH FRAX ETH trading pair with a lot of liquidity incentivized to that pool, easily using the amount of Convex they've amassed. So
Yeah.
in a way, it's a smart strategy for a stable coin provider to accumulate lots of Convex. Then we can look at the team and investors. We already spoke about the founder, Sam Kazemian. Just a little bit of a background on him. He's a Iranian-American software programmer. He previously co-founded Everypedia, a for-profit Wikipedia-based online encyclopedia, so nothing really crypto-related. And in 2019, he founded FRAX. So not too much of a track record, but judging by the way the FRAX team ships out updates and different product lines, I think he's very solid. And considering the commentary he gives on Twitter, etc., he's clearly very knowledgeable about the space and has a clear vision for the protocol. And because of that, I guess they have, a lot of reputed investors and backers, including Dragonfly Capital, Crypto.com, Electric Capital, Multicoin, Galaxy Digital, Stani from AAVE, Balaji Srinivasan, bankers, synthetics. I mean, just a ridiculous list of backers and investors. Now, I'm not saying that means it's bound to succeed, but it does give it a little amount of additional credibility, I guess.
I mean, yeah, kind of, but at this point, not really.
Yeah, I mean, I don't think that project should be judged based on who's backing it. The project should
It's
be
just an
judged on
additional
what the
data
project
point.
is.
It's just an additional data point.
Yeah. So with that, we
I mean,
can finally
especially
talk
because
about
they've got
price.
Crypto.com and Multicoin.
Yeah.
Like, I mean, like, fine.
Yeah,
like,
not. Yeah,
Yeah. Anyway,
for sure.
sorry, go on.
So now we can finally talk about the price action of FXS. So it's been pretty volatile, honestly, but that's pretty much any cryptocurrency you look at. There's very few cryptos that kind of don't move with the market and are not highly correlated with Bitcoin and Ethereum. So FRAX, I think it reached a high of around $40, but it settled at around $4 currently. So obviously massive drop in value. But even with that massive drop in value, the peg has been maintained very, very solidly. So I mean, that's kind of proof that, or not proof, it's proof so far that the peg can be maintained even with massive drawdowns in price for FXS. And although, I mean, I am seeing that, that death spiral potential risk, I feel like that's a very, very, very tail risk. So it is possible, but not as much so as Luna and USD was in a way. So yeah, I mean, if you invested at the right time at FXS as you did with any crypto, you would have made money. The problem is the market is just so heavily correlated. It's tough for the projects, uniqueness to really shine through when everything is just moving together. And that leads us to, the major risk to FRAX, which is a death spiral essentially. Very similar to Luna and USD. And another thing that happened, which was much smaller in scale, but still should be pointed out, is that when the FAE protocol and Rari, they fused together it was kind of a merger of two DAOs to create Tribe DAO. One of their fuse pools essentially got hacked, and 12 million of FRAX protocol's money was essentially stolen. They ended up making the victims whole, I think, and in the grand scheme of things wasn't a big deal to FRAX. But what this points out is that FRAX has a lot of exposure to lots of different DeFi products now because it's all over, right? And that increases the risk in general to the project because it is, but also it is at the same time, it's also diversified, so it can work both ways.
And also,
I mean, I'm not sure if I'm explaining that really well.
No, I think I get what you're saying. I mean, like, it's basically that the AMOs that FRAX uses as a value accrual mechanism for the FXS token, right, do hold with them a certain amount of risk. And you have to understand as an investor and as a user whether you want to indulge in those kinds of risks, and more than that, trust another party with your funds to be able to make best use of those funds, right? And I think this is a point we haven't really discussed, in the sense that, like, the AMOs to a certain extent do depend on users trusting FRAX to earn them yield. And that's that's fair, I guess, but it's not like it's not pretty risky. So important to keep that in mind.
Yeah. With that, I think we can conclude. My overall opinion on FRAX is that it's a very, very interesting DeFi protocol, made some really interesting design choices. The team ships products really fast, and because it's governance minimized, it's easier for the protocol to make upgrades because the core product doesn't really need to be messed with, and they just need to add incremental product lines and upgrades to ensure essentially how we discussed that the FXS token ultimately accrues value. That's the whole game here for this to succeed. So I think it remains to be seen whether FRAX will succeed, whether it'll be the decentralized stablecoin. But so far, I'm impressed by them.
Yeah, I think my opinion is just that it's a worthy experiment, and that there are many things that we can pick apart that we've been trying to do so, which is actually a good thing because we should be picking these things apart. But at the end of the day, yeah, like just I think Sid and I have both latched onto these words, but it is a worthy experiment. So that's just my my conclusion.
Yeah, same put.
Cool. I think that's it, guys.
Yep,
Yeah, with that, we can conclude a long episode this time.
No, I think this was a good. I think we covered the important parts, and I think stable coins are one particular topic we don't want to
skimp out on.
Yes, exactly. We want to cover as many aspects as possible. I think we did a good job here.
Cool. Cheers. Thanks, guys. And yeah, thanks everyone for tuning in. Yep. And catch you guys next time. And stay safe. Keep not your coins, not your keys. We're going to repeat that from last time because honestly, it can't be emphasized enough. But yeah, thanks guys, and see you later.